Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. In this edition of the Moneymakers Investment Trust podcast, I am joined again by Peter Hewitt, the manager of the CT Global Managed Portfolio Trust, which has two distinct arms, one that generates income, one that generates growth, and you can opt for either of those. Peter, you've been a regular on this podcast now several times, and I think we have to start by talking about the whole Saba Capital saga, which came to its first sort of critical point this week with the vote at the requisition general meeting at Herald Investment Trust, ticker HRI, managed by Katie Potts for many, many years. Saba failed to get many votes to support its position, trying to replace the board and appoint itself as the manager. So obviously this is only the first leg in a campaign against, in the short term, 7 investment trusts where it's requisition meetings, and there's another dozen or so which it has significant shareholdings where it may be or maybe not about to do something similar. So first of all, can I ask you, what did you make of the outcome of the vote at Herald?
Well, good morning, Jonathan. Good morning, everybody. Well, the answer is I was very pleased. I, as a shareholder of Herald, have been for a long time, and I think I've got just under 1% of the company, and I definitely voted against the Saba proposals, which were just not very interesting, which we'll no doubt come on to. But I think the result itself was extremely encouraging for Herald, for Katie Potts, and I think that also for the other trusts that are subject to the Saba resolutions. So Saba had built up their holding to over 29% of Herald, and I think I'm right in saying they hardly got any votes additionally to their holding, something like 0.1. And I think that is a very important number. They garnered no support whatsoever. There's a huge turnout of over 80%, which really is very encouraging. And of that, 65% in total voted for company, for Herald, and 35 of those who voted for Saba. But of course, 80% of 35 moves down to 29 point something, which is basically the Saba holding. So actually, Herald did well. They corralled all the votes from private wealth. One or two people are saying they didn't have quite as big a holding amongst the platforms as some of the other trusts under fire, but they clearly still got a very big outturn that voted. And all the comments, the media comments from the shareholder organisations, PERC and ISS, all the rest of them, were all recommending people to vote against. And they did. So that was very encouraging. And we're going to talk, Jonathan, about what happens next. But it's just worthwhile for everybody to understand, and hopefully Saba themselves to understand they had no support, none. And the proposals themselves are basically to give Saba the management contract, which is what they wanted. They had a whole lot of huster and bluster about discounts. And I saw a comment from this guy that runs Saba, because Herald have got a fantastic long-term performance record. I know, I've held the stock since I was launched in the managed portfolio trust in 2008, and I'm just looking here, the market value today is almost 5 times greater than the book cost. So that's a 5-bagger. All right, that's 17 years, but that's pretty good. And that's despite it supposedly being at a discount. And he said, Katie Potts, 20 years of miserable discount management. Well, here's some miserable discount management for you. You look at the two Saba funds listed closed-end mutual funds in New York, 10, 12 discount. I think you should really have a hard think about that. That's poor from a shareholder's point of view. If you can't close the discount, maybe you should think about closing the funds, because really, that is very, very poor indeed. And the phrase pot calling the kettle black?
So fine, I get that. I mean, I talked to him myself this week and he had interesting things. But I guess the question you still have to ask is how come he was able to buy 29.8% of the trust if it's doing such a good job and everyone is happy? somehow 29.8% of the shares have changed hands and ended up in his hands. So there has to be something
and
that's not quite
also
right.
the other trusts, Jonathan, and a raft of the other trusts that are under fire from him at the moment, and also a whole series of other trusts that he's got holdings of 5%, 10% in. And I think, yes, one of the side effects of this has been perhaps boards and or management companies should have been more alert to what's going on, more perhaps rigorous in discount management. I think that is a valid criticism. And so we can thank Saba for that. But I also think if we just step back and look what's happened to discounts across the sector over the last 3 years, since at the end of 2021, the average sector discount got to 2, and by the end of 2023, it was at 19. And actually, I just checked today, and it's almost 16. So it's still very wide. And I think what that says to you is that in an environment when inflation is going up and interest rates are going up, then discounts are going to widen on quite a number of trusts. And then lobbed into that, you had just an absence of buyers. And the traditional constituency who's bought a lot of investment trusts and still holds big positions has been private wealth. And they have been largely absent in terms of supplying demand for shares, despite the apparently attractive valuations. And I think that too has been an issue. Where have been the sources of demand for a whole variety of trusts, geographically, by sector, alternatives, across the board really? And apart from companies buying in shares, and to be fair, a lot of companies have bought in shares, although perhaps not in the quantum that would have been needed to really make a difference to the discount. And so I think it's been perfect timing from Saba in that you've had this horrible storm that's happened to the sector. And I do think, yes, boards and managers probably do take some responsibility there, but also I think discounts perhaps were too tight at an average discount of 2. And it's not easy to fight against some pretty important macro trends that were going on. So the whole supply-demand equation, what's going on in a macro sense, then kind of zeroed down into discounts that you've seen that Saba has kind of taken advantage of.
So I asked him actually, how did he pick the 7? Because it's a pretty odd bunch that he's selected for the 7. There's pretty disparate things and all very different in what they do. I think it's clear that his knowledge of individual trusts is not perhaps as great as you might think. But he just said, well, they're the ones where it was easiest to build up these large positions. So he was just mopping up all the people who were selling. And while it's true that last year we had record amounts of buybacks and we had more consolidation and mergers and things, it still wasn't enough, or still hasn't been enough, to actually close this imbalance between supply and demand. And then you hear some boards, not all, some boards of investment trusts saying, well, we bought a few shares, but we didn't buy a lot because really it doesn't work. Buybacks don't work. You hear that argument very often. But of course, that's a rather self-serving argument, I have to say, because obviously they only work if you do mop up all the excess selling, the people who want to actually sell out. So you have to mop all that up in order to get a result. So I guess my view is, notwithstanding boards did a lot last year, but this is basically still a bit of a wake-up call. I mean, it's been impressive how they've been galvanized into getting the vote out and communicating with shareholders and talking about they're going to return money and so on. But it really has been a wake-up call for some boards, has it not?
It definitely has, Jonathan. And I think it kind of became convention that, yes, boards would undertake buyback operations because perhaps in some cases they had issued shares in better times in years before. And that is the right thing to do, be under no illusion. But I think to make a difference to discounts, the quantum has to be materially different and not just one-offs continuing. And so what that's saying to you is there's a lot of trusts that are going to be quite a bit smaller going forward. And of course, boards and managers reluctant because, private wealth won't buy us if we're less than 1 billion, less than 800, less than 500 million. I mean, that may or may not be the case, but I think you've actually got to look at existing shareholders, the NAV, the share price, and make sure the share price is a heck of a lot closer to the NAV. If there are discounts, make them in single figures and as small as possible. And I think you can make a difference to discounts through sensibly managed buyback policies. But I think what the boards and managers have to kind of come across the Rubicon is your trust is going to be smaller. And if you want to have a trust going forward, then you have to accept that and get on and get the right share price, the right rating for whatever the trust may be. If it's a listed equity trust in Europe, UK income, doesn't matter. And I think that's where the wake-up call has been issued. It will be interesting to see if it's taken on board. I suspect it does really need to be now. And if it were, I think you would have probably a smaller sector, but much less discount volatility and narrower discounts. And you know what? That would probably be more attractive to potential buyers, not just individuals and platforms, but actually private wealth managers too, and multi-asset funds and family offices and the likes. And they would look and say, well, the discount seems to be moving between 5 and 7 or 4 and 6 or whatever. That's not a big issue. And we know it's not going to balloon out towards 20 because the board has said they're just going to mop up a lot of stock if that need be. And then you get situations when markets are a little bit more friendly and presto, they're selling with half decent performance at par or above and able to issue stock. So I feel that argument has got to move on and may well do, hopefully, as we get through all this stuff. So yes, Saba has definitely thrown a light on that. And perhaps in the fullness of time, we might be thankful for it.
Yeah. I think it's fair to say, if I can say this without getting your ears to burn, you run a trust which is obviously below this sort of magic 500 million threshold, and you're very popular with retail investors, and you trade close to par all the time, and you buy back shares and you also issue shares when you can. So, and you put more effort into communication than a lot of trusts do, I think it's fair to say. And Saba's not on your tail, which I'm happy to see. But do you think that there's lessons from your own experience that other trusts could think about?
Yes, do you know, Jonathan, there is. And we've got completely different share register from lots of trusts. We are only owned by individuals, so no private wealth at all. And when the Managed Portfolio Trust was listed just before the financial crash, so brilliant timing, in April of 2008, we were about £40 million, so tiny in the great scheme of things. But I was determined. We were a fund of investment trusts, so there was an underlying discount in the holdings. I was not going to have a double discount of the share price of the Managed Portfolio Trust being a big discount to its asset value. And you just have to say that and then demonstrate to the market makers. And so I presumed there'd never be a buyer of a fund of investment trusts. And I said to Winterfloods, who are our main market maker, if ever you're left with stock, phone me up and I'll buy it off you. And if it means we shrink from 40 to 35 to 30 and eventually to nothing, so be it, because I'm not going to let this happen. And it took a while, but they got the message. The trust actually, in March of 2009, got to 28 million. And that was due to a lot of buybacks and horrendous performance over the financial crash. But here's the thing. Then the neutral position was us to be trading at par, both the income shares and the growth shares. And so the market maker got confidence that the manager would hang out to dry with a whole lot of stock. Hey presto, we started performing, and then blow me, we started getting people wanting to own the shares. And amazingly, over the next 10, 12 years, we issued well over 50 million quid's worth of stock, still doing periodic buybacks, because I still assume nobody would ever want to buy a fund of investment trusts. And, the rest is history. We trade where we do, one's at a slight premium, there's a tiny discount. We buy in shares on a 3 discount, we issue on a 1.5 premium. It's very tight. But I think what you have to do, the manager and the board, is literally go to the edge of the precipice and look over. And there you see oblivion and you're buying in endlessly and the trust is going to be so small it just have to be liquidated. But actually, you have to have the kind of wherewithal to do that. And if you do that, the market then gets confidence that you're there, you're not going to let a discount happen. And amazingly enough, once some of the market makers have got that, then actually the share price begins to correct and hopefully moves towards a sensible rating, and let's say that's round about par. Now, it won't be easy. Lots of different asset classes, different shareholders. I've made it sound it's not. But actually, that's what needs to be done.
I mean, there's a question really of credibility, isn't it? If you can convince the market, as you're saying, that you will always be there to do that, that will eventually work if the markets believe you. And if they do, you get that permanently good rating. But is it fair to say, one has to tackle this issue, I guess. I mean, you've been around in the investment trust industry for a long time. I think I can say that, as have I. And of course, the line that Mr. Weinstein takes is, well, it's all just a cozy chumocracy, basically. And the boards don't want to give up on their nice fees. And the fund managers don't want to lose their fee income either. And so, therefore, there is a sort of, I wouldn't call it a democratic deficit, there's a kind of a mutual self-interest in not doing perhaps as much as you might otherwise do.
I wouldn't disagree with you, Jonathan. I think you're probably right there. And I think lobbing on this, what I said earlier about private wealth, the mergers that's happened there. So some of the major private wealth companies are now huge institutions, and they don't want to be locked into smaller investment companies with not great liquidity. I understand that. But here's the thing. If you've got a very active buyback policy, Mr. Private Wealth Manager isn't going to be locked in. Because if they want to sell and there isn't any buyers, the company will buy the shares off you. And actually, that message needs to get out there. And it's not easy, but I think in the case of boards, I think there's a lot of good stuff on boards, and they want to do the right thing generally. And they are experts perhaps in the field the trust is in, or have had other expertise that brought to bear, legal, accounting, all the rest of it. And so I would not be critical of that, but actually what you do need is an understanding of the investment trust structure and all that that means. And if there is a bit of a deficit, that's where it is, because there's a lot of good boards that just don't have that. Intelligent people, knowledgeable people who make the right decision if it's in an investment context, an accounting context, whatever that may be. But one thing in common is all these portfolios are wrapped and called investment trusts. And I guess this comes back to what you were saying earlier, Jonathan. You have to understand what that means. The pros, which are long-term, closed-end, all of that stuff. But you have to ensure that proper ratings are there. And so boards and managers, managers love the fee income too, and it's long-term fee income, but they have to understand that sometimes it can go down as well as up if you want to have a sensible vehicle going forwards. So I think that definitely is a side effect of all this stuff just now. And hopefully the majority of boards will take that on board. And so investment trust experience of the structure and the knowledge of it is vital to see on a board of directors.
Yes, and that I think is a very important point. We have actually seen on its standalone merits, this idea of increasing diversity and so on boards is a good idea in principle, but perhaps it's in this particular period where specialist investment trust expertise is badly needed. Maybe it hasn't been entirely optimal, shall we say, at this stage. Let's move on there and still talk about Saba, but I think if you look at the way they've built up their positions, in most cases, they're probably still sitting on a sort of profit at the moment, though they've been buying right up to close to par recently in some of these cases. What do you think is going to happen? How are they going to be got rid of? I mean, the chairs of the board say we want to get rid of them. How is that going to happen? Or is it going to be effective as some form of green mail, or is it going to be they're going to come up with tender offers or whatever it is? How do you think that's going to play out? I mean, assuming that Saba don't win any of these votes, but I wouldn't necessarily assume that you can read straight across from the Herald result, because Herald has a particularly loyal and long-standing shareholder base, which has a lot of built-in capital gains as well, as you say, for private investors. So what's your guess of how this will play out, and what would be the best outcome for those particular trusts? So talking about Herald, for example, what would be the best outcome there?
Well, yes, and this is the great uncertainty now. I mean, the statements coming out of Saba actually are that we're here to sort this out and we're not going away. Don't expect that. We've kind of lost this vote, but we're not going to lose the war. And I understand that. And I don't think in the case of Herald, they're immediately going to exit Herald. They'd find it very difficult anyway, Jonathan, to sell 29% of Herald. So what's going to happen next? And I do think, firstly, let's get through the votes. And you're right, they may still win certain votes, particularly ones that have got a lot of shareholders in platforms, and hopefully they'll turn out to vote. But then again, what if the vote is fractionally above that of Saba? So you've won that particular battle, but what could happen down the line? They might come back again in a few months' time. That is also possible. So I think we're not going to have to wait long. By the middle of February, you'll know all the various results. And I think the thing is, in the case of Herald, I don't know, the Herald board will be going over it with the manager, their corporate advisors. There's not an obvious, elegant solution to this. But I think what you can say is most of these trusts will probably be smaller going forward, in that if they manage to get Saba off the list, there'll have to be some sort of tender and that close to asset value. And so I think what they have to make sure is if they undergo that, that actually other shareholders don't take advantage of it, Saba doesn't. And suddenly Saba's shareholding becomes a lot bigger in the trust and eventually they achieve their aims. So there would probably need to be some sort of conditional agreement that Saba were going to join in the tender. But I'm afraid to say some of the trusts will be smaller. In case of Herald, it's well over $1 billion. It's $1.2 billion, I think, in terms of assets. So I don't know what it'll end up with, but it'll be hundreds of millions. It'll still be a sizable, good-going trust. I hope that is the case. But I just think there's not an immediate, obvious, elegant solution beyond some sort of tenders that Saba take part in. 2 of the 7 trusts are hoisting the white flag anyway and giving cash back to shareholders. Henderson Opportunities, where I'm a shareholder also, and I think Keystone Positive Change. The other ones, Baillie Gifford US Growth, I would be astonished if Saba won that vote. I think that one hopefully will go the way of Baillie Gifford. But the other ones, I'm not so sure. European smaller companies and Edinburgh Worldwide. Edinburgh Worldwide's got a big holding amongst the platforms, so they have to get them out to vote. But let's hope they do. And if there's a decent level of voting, then the message to Saba that was against the Saba proposals is that actually, guys, we understand what you're saying, but you've had no support from any shareholders, whether it be individuals, private wealth, whatever. You just had no support. And so they, Saba, need to think about that. And the fact that they're getting absolutely zero traction is quite interesting. So I'm sorry, Jonathan, I haven't got an obvious answer. We'll have to see how this unfolds. But we're not going to have to wait long.
2 things he did say to me, and I think he said to others as well, so it's not like it's particularly special, but he did say that they've been involved, I think, in 70 situations, and only 2 of them they actually won the vote to take on the assets. And he is, by trade, he's an arbitrageur. You know, it'd be nice to get this extra money, but it's not normally what he does. But they've got to find a way to get rid of him. Otherwise, there will be a problem. But I was going to say that the shares of most of the 7 anyway, well, they've actually performed quite well over the last few days, but their discounts have widened a little bit. So your Herald holding will have gone to a wider discount than before?
Yes, they will have. And that's not a surprise. And I thought the other interesting thing was this agreement with most, I think, of the BlackRock trusts of kind of a standstill agreement with Mr. Weinstein and Saba, so they won't be attacked. Now, I don't know all the details of this, and BlackRock and Saba have history in the US, and that probably coloured the views here. So watch out perhaps for more agreements like that. I'm not sure. And I certainly think Saba in the short term are not going away. But if they keep losing these votes and gaining no support elsewhere, then actually at some stage, and I don't know whether the Saba shareholdings are highly leveraged and there's a cost to that. We don't know how long they can sustain them. Of course, they're saying it's for the long term. Although I think one thing we've learned from Saba is long term's 3 years, because that's what the focus on all the performance records were. So anyway, we shall see there. But I think definitely the result of Herald is a step in the right direction. There are lots of lessons for boards and managers to take on board when this is finally played out. And the playing out of it will be interesting too, as to whether actually Saba begin to sell stock at some point or take advantage of an offer, because they will have done well. And actually, Jonathan, it should be remembered, if they were a traditional activist and just bought the shares with a view to closing the discount and exiting at par, they probably would have achieved that and made some pretty tidy profits. But sadly, they wanted to manage the assets, and I think that turned people against them.
Yeah, I think that may be true, and I think that may be a lesson for them as well, interestingly enough. You mentioned that you're a shareholder in Herald and you're a shareholder in Henderson Opportunities. But your reaction is you're not going to sell shares just because this vote has gone against you. I mean, Henderson Opportunities, that's one of the two you're implying is going to disappear anyway because the board has decided it's not long-term viable. And Keystone Positive Change, I think, is the other one, which where they've offered a rollover into the open-ended equivalent as well as a cash return. So when you bought Henderson Opportunities, you didn't buy it in the expectation there was going to be an activist on the register, right? That wasn't the reason you bought it.
I've held it for years, and it's done. You could probably say it's had a mixed performance record, but it's had its moments when it's performed very strongly. Two great managers, James Henderson and Laura Fall, and I own their other funds, Lowland, which is a UK equity income fund, and also Law Debenture, which trades at par and trades very well. Lowland actually is at a discount. I'm not quite sure what it is at the moment, but Saba, I think, own 5% of that. And actually, John, that's another thing, is they own stakes in lots of other trusts. What are they going to do there? Because I think if they try and sell 5 and 10% blocks, that would be difficult. But who knows? You see, if they try and declare war on trusts, if look at what's happened already, they're not guaranteed to win, and they're gaining no support from any other quarter. So there may be more, but this is what comes back to buybacks. And altogether, probably a smaller sector, but better rated. And I think that's the way, hopefully, that we're travelling.
And as a fund of investment trusts, as you said, as a manager of that, you would welcome that. Obviously, if we go back to an environment where discounts are smaller, would you welcome that? Or would you say, I will miss some opportunities there to buy things on wide discounts that are particularly attractive, et cetera, et cetera?
Listen, there'll always be some trusts on wide discounts and for differing reasons. But in the main, yes, I would be happier if the sector was apparently smaller in market value terms, but average discounts were not 16, but 5, which kind of implies quite a number are selling round about par. And if you think that through, one of the worries was, private wealth managers or family offices or multi-asset funds won't want to buy our fund because we were just over the supposed borderline of 400 or 500 million or 800 million, whatever it is that they require for liquidity. But actually, if they just look through that, what they'd see is boards are prepared to buy in shares in quantum. So actually, if it's a £400 million trust and a private wealth manager's got 7% of it and they wanted to sell and they couldn't sell for whatever reason, there was just no interest in buying the shares, then the board could activate the buyback program and buy some or all of the shares. In other words, provide them with liquidity. And I think that's where they need to get away from size of funds, because there's some quite big funds that I own. I don't really view them as being very liquid. There's other smaller funds, or apparently smaller in market value terms, that are very liquid. You can buy and sell quite a lot. And so if boards and managers are then providing liquidity, you've kind of provided a bit of an answer to some of those issues that seem to be affecting the sector regarding size.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. To sign up today at money-makers.co. And thank you for listening. So you recently put out some results, Peter, and we briefly talk about those, I think. We've talked a lot about Saba and the general environment. I haven't asked you about Mr. Trump and whether that's going to make a huge difference to the world, or what's going to happen to interest rates and so on. But let's just, for the moment, concentrate a little bit on what you've been doing. You've put out some results, and you had a presentation earlier this week. And you talked about some of the things you've been buying and selling, or top slicing, or adding to positions. Can you give us a brief summary of that and the sort of reasoning behind that? Let's start with the growth portfolio, if we may. And I see you've been adding to or buying the JP Morgan Smaller Companies Trust, TR Property, Henderson Smallers, and Scottish Mortgage. That was the ones you mentioned in your portfolio. So what was the thinking there? I don't know the sort of quantum of these things, whether it's material or not, but what was your thinking there, and what were you thinking in terms of the ones you either top sliced or sold? You sold some of the flexible investment ones, a little bit of capital gearing, a little bit of personal assets and so on.
Well, yes, John, that's what I've been doing. I've actually not been doing much over the last 6 or 8 months. It's actually been fairly small additions to or reductions in certain holdings. The one that sticks out there is Scottish Mortgage, which is the biggest investment trust by some considerable distance. And it's had a long-term fantastic record. For the last 3 years, £15 a share in November 2021, £6 a share by the following summer. And here we are today, and it's £10.50. It's clearly on a recovery tack, and I attended a big seminar they ran in Edinburgh a couple of weeks ago. I think they did one in London the following day. And Scottish Mortgage is definitely on a recovery tack, and that portfolio is looking really quite interesting. Of course, don't judge a book by its cover. Scottish and mortgage, it's got nothing to do with mortgages or anything. It's high-tech investments, really at the cutting edge. You've got some really interesting private companies. Isn't it interesting how not that long ago, private companies within Scottish Mortgage were viewed quite negatively, actually, by the investing public and analysts. They had too much of them. What was the proper valuation? Now, some of these businesses are coming through, and some. SpaceX, the Elon Musk kind of satellite company, is to the forefront, but they've got a number of other really interesting ones too. And on top of that, the listed equity holdings that they've got, and some of the big tech companies we know, Amazon, Nvidia, and the likes have been doing extremely well. But some of the other holdings in the portfolio have been kicking in. And I think Scottish Mortgage, which by the way is still selling on a bit of a discount, I think it's tightened in a bit now. It's single figures. They'd never stinted in terms of share buybacks. But I think Scottish Mortgage pointed the right way, and I've added to it 3 times over the last 6 months. So it's now back in my top 10, and I'm very happy with that. And I think it does look well placed going forward for some decent asset value gains. I mean, in general, I've been espousing 3 key themes to the growth portfolio and the income portfolio of sticking with your secular growth investments, e.g. Scottish Mortgage, and they have performed really well in recent months. But Polar Cap Technology is now my biggest holding. Allianz Technology, Monks, another bailiff one, Scottish Mortgage, they've all been doing really well. Another theme of mine have been UK equity trusts. And we know the UK equity market is inexpensively valued. These trusts are on wide discounts, but they've not performed. And there's 1 or 2 reasons for that. And we're back to the situation again when the FTSE 100 index of biggest companies is leading the market. So just in January, calendar year to date, the FTSE is up almost 5%. The 250 index of the UK's mid-cap companies, and mainly growth companies in there, may I add, is flat. And the small-cap index is down too. So that's back to the situation we had in 2022 and 2023. And I just looked at some of the data sheets, and almost every active manager in the short term is underperforming. So the all-share index is the best performer. And that's because active managers will tend to be overweight medium-sized and smaller companies because they have better growth characteristics. And they might like Shell, they might have a holding in Shell, but Shell is 7.5% of the FTSE. And to make a difference, if Shell is performing, you'd have to have 10% in Shell. And a lot of fund managers naturally recoil at that, too much concentration. So I still believe firmly that UK equity trusts will come through despite the worrying macro signs we see. Discounts are wide, and that's, you see me buying JP Morgan UK small cap, Henderson smaller companies. They're on wide discounts. They've got good fund managers. And I think looking out, they will hopefully perform over 2025. And just one final thing on that. There's great worries over the UK economy, and the budget did not go down well, and confidence amongst consumers, the great public, is falling. But actually, the fundamentals, relatively full employment, and significant real wage growth is very positive for consumer expenditure. So they've just got to get over that confidence issue, and hopefully then you would see that as we move through this year, because 70% of the UK economy is consumer spending, and that's key. So hopefully that will come through, John, and we get some performance from that area.
The other theme that you talked about was private equity. And again, there, we haven't seen quite as much progress there as I think as many people were hoping in terms of the discounts there narrowing. They have come in a little bit in some cases. There has been some effort by boards to introduce capital allocation policies that are designed to at least have an effect on the discount. But it hasn't really happened, has it yet, in a significant way? Some case-by-case differences. You're still sticking to that theme as well, are you?
Yes, I mean, the performance of some of the private equities has been reasonable. Some have lagged. Discounts are still very wide. The whole cost disclosure thing, which I know is one of your favourite topics, Jonathan, you love discussing it. Hopefully that will move in the correct way going forward, albeit that the FCA came out with recent proposals which really were not great at all. But let's just say we're going to move in the right direction, and investment trusts generally, and private equity trusts in particular, will not be burdened with apparently showing very high costs. But here's the thing. If you look at some of these private equity trusts just now, the net asset values of them are starting to show some growth. So they often produce stuff on a monthly or quarterly basis, and suddenly you see it being +2, +3% for a quarter. Now, some of that might be currency and different things, but actually the realization environment for private equity trusts to sell some of their holdings is definitely improving. And that's really important. And so I think if you see some of these trusts producing net asset value growth, which has been, broadly speaking, sideways for a couple of years, suddenly +8, +10, +12% for some of the better ones, and the share prices just don't move, you're then going to get discounts very quickly move from the mid-30s to the mid-40s, and then potentially even wider. So I'm happy to be a holder, not happy with the discounts, happy to be a holder when the underlying assets are actually improving. And look at Pantheon, look at ICG Enterprise, look at Oakley Capital, Apex, which has not done all that well of late. That's beginning to come, some realizations there. Partners Group also. These are trusts which are on wide discounts, and frankly, it could happen quite suddenly. You see asset values up again, and the penny drops for some of the investing public, and a 35 or 40 discount moves to a 20 discount, and you really get some quite strong share price performance. I'm actually quite confident the outlook for private equity this year.
Well, you make an interesting point there, because I've just been looking at some numbers on private equity, and this is a very short period, so of course you can't extrapolate, but interesting nonetheless that since the start of the year, as you say, we've seen some positive NAV movements on quite a few trusts, and yet the share price is actually down on the year to date. So that's an interesting dichotomy. Maybe the investors haven't really woken up to this fact about the NAVs, as you say, or else they still don't believe them. But yeah, it's interesting. Do you own RIT? Is that one of the ones you own or not, Peter?
Yes, RIT Capital is one I own, and honestly, it's been selling at a very wide discount also. But again, the underlying NAVs, I think it's up about 10% over the last year, and it seems to me it's moving in the right direction. It will take time for that, I think, to reflect in the discount, but I'm a happy holder there. I have to say, Jonathan, the area that's not done as well has been my income portfolio. And the reason it's not is the trusts that have been performing, the Scottish Mortgages, the Polar Cap Technologies, clearly they don't pay dividends or very small dividends. And also, generally, exposure to US equities. So JP Morgan American, case in point, has performed extremely well. That doesn't have much of a dividend. It's very difficult to get a lot of exposure to US equities in an income fund. The best performer has been JP Morgan Global Growth and Income. That gives you a 4% dividend, partly paid from capital, but it allows them to invest quite a lot in the US, and that's been the best performer there. And of course, the other area that has lagged, and at the Winterfloods conference yesterday, there was a panel session of some of the best renewables managers, has been the share prices of some of, firstly, alternatives generally. Infrastructure, renewables have been terrible. That is now becoming the widest discount area. Renewables Infrastructure Group 35 to 40 discount, a 9.25% yield, which is normally a warning sign, growing at 4%. The underlying fundamentals seem okay. So the share prices are just quite disconnected with what's going on. And actually, at the moment, power prices in the very short term are going up. But the investing public doesn't want to know. And that's damaged my income portfolio. But the income side of Greencoat UK Wind or Renewables Infrastructure Group has been coming through quite well.
It's very strange, isn't it? I've been surprised by that as well, that they haven't recovered at all. In fact, they got worse in terms of discounts. And I think Greencoat UK Wind is the best at -20, which is extraordinary, really. So my thinking has been, well, these trusts all raised a lot of money again before we moved into this new low discount era. Maybe this is the year when the boards there really have to step up and start thinking about some rather more active ways of trying to get those discounts in, because otherwise they're going to be facing some existential questions as well, aren't they?
Yes, they are. And of course, it's not so easy to sell a wind farm or a solar farm. They are alternatives. They don't own listed equities. But you're spot on. If you have discounts as wide as this persisting, something will happen. And I'm not sure if it would be Saba, but who knows? Private equity might take a view on some of these companies. They are trying to sell assets and have done small parts of their portfolio and justified the valuations they're carrying for their assets, but it's not really made much of a difference. And I think that could happen down the line. Quite what form it would take, Jonathan, I'm not good enough to know. But I do know where you've got significant cash flows, not overly indebted companies, but on very wide discounts, you can be sure eventually there'll be a crunch point. And that could be something you're discussing later this year or beyond. But I've been surprised as well. I mean, our income portfolio yields 6.75%, and we're growing that dividend at 3%. And it trades round about par. But the underlying asset performance is behind the all-share index, because I've not had some of the secular growth trusts. UK equity trusts abound, global equity income trusts, but, they've not been really performing that strongly. And the bellwether I always look at, Jonathan, and a lot of the audience will know, is Mercantile, which is a big trust, the thick end of 2 billion. It's well run, a solid manager, sensible manager, invests predominantly just in the 250 index. So actually is exposed to the best growth companies in the UK. The discounts out in double digits again. It's obviously underperforming the FTSE 100. But if you see a change in that and mid and small caps start having some traction, then that's a trust that will just very quickly, and we've seen it in flurries in the last couple of years for a month or two, then suddenly it's all lost again. But that's the sort of trust, and there are others, I've just selected Mercantile because it's so well known, where you could see a very significant return from the underlying assets and then the discount closing. And by the way, Mercantile has a yield of 3.5% plus that's growing. So you're paid to wait.
Behind this also, there is one sort of big iceberg, if you like, and that is particularly true in the case of the renewables, because they do appear to trade very highly correlated to what's happening to gilt yields. And I guess it's about a question. If you can get 5% on a decent, reasonable gilt at the moment, they may be going higher, we don't know, but if you get 5% yield there, why would you want to get 6 or 7% from a renewable trust which has got lots of uncertainties around it in terms of power prices and so on and so forth?
First, I would say, think not 6 or 7, but 8.5 and 9, and growing. But you're right, the share prices of these vehicles, and not just infrastructure, but in other areas of alternatives, are very sensitive to bond yields. And there is a risk, and I think the risk is mainly in America, that President Trump, the American economy is growing strongly, and if he cuts corporate taxes and enacts some of these moves with regard to tariffs which boost inflation, you've got a tight labour market, inflation re-emerges a bit in the US. Suddenly the Federal Reserve isn't talking about cutting, but maybe in 2026 thinking of possibly having to increase interest rates in order to stem inflation. Now, I'm not saying this is going to happen, but you could see a risk that the 10-year bond yield in the US tracks towards 5 and keeps on going. Now, in the case of the UK, we're actually have a 10-year yield very similar to America. It's currently 4.6. I don't see the same pressures on the upside for yields. Of course, they're having to issue because borrowing is high, but the inflationary pressures aren't there at all. And neither is our economy growing anywhere near as fast as it is. So the inflationary pressures just aren't there. My feeling is, I'm not a bond analyst. Could long gilt yields get to 5 in the UK? I suppose they could do, but I don't see them tracking on much higher than that. I really don't, unless there's a major change in underlying fundamentals. And actually, if they start to get inflation under control a bit, there is scope for some cuts in interest rates from the Bank of England, and those bond yields might come down a bit. And so in that scenario, you've got a renewables trust that's yielding 9%, that's on a 35 discount. Actually, the words positive and performance might happen to that sector.
Well, at some point it will have to happen, as you said, I think. That's a perfectly reasonable thing to say for that particular sector. But in general, about interest rates, yeah, I think the outlook is perhaps not as good as many people hoped it would be. I think we can say that for sure. The final point here, just to take a longer term perspective, again, I'm always interested in the fact you've been around this business for so long. We did have this period when everything was trading around par. We went to 2% average discount. But that was the era of zero interest rates, essentially. So suppose interest rates stay roughly where they are. What do you think is a sort of normal, steady state kind of average discount we would expect? Would it be somewhere between 5 and 10 or something? We're not going to go back to everybody trading at a premium. I think that's pretty clear.
Yes, I would agree with you there. And I think somewhere in that region for the average sector discount would be fine. So the average sector discount, so the likes of a private equity trust, and they are out discounts, as we've said, 30, 35, approaching 40, they probably, for liquidity reasons of the underlying holdings, will never quite get to par. What is the right discount? I don't know. 15, say, for example, for an average fund, 10 to 15. So that's on the wider side of average. For an investment trust invested in listed equities, and this gets back to what we were talking about with regard to Saba, the neutral discount should be quite a bit tighter than that. And if we said 5, listen, there's no scientific justification for that, but that would imply quite a few of them are trading at par, and 3, 4, 5, 6 feels like the right sort of area that they should be trading at. And I think that's a reasonable expectation in time, given what you've just said about interest rates, inflation, and bond yields. And so that gives you an average sector discount, probably in the 7 or 8 region. And I think we could all live with that. There would obviously be outliers both ways, but I think that's what we've got to strive towards in terms of investment company sectors. And this is where boards and managers do have a big role to play, as do the potential buyers. And private wealth has largely switched off from investment companies because it's been far more important to have NVIDIA and Amazon in your clients' portfolios than a well-managed investment company. But actually, what happens if NVIDIA starts going down the share price? People have never thought about that. And actually, there are other areas, and suddenly the mercantiles of this world appear to be a sensible alternative. So I think that's what we're looking at going forward, hopefully, Jonathan.
Well, Peter, it's always interesting to talk to you. We had a good Barney today, sadly, about Saba and the whole sector and so on. It's traditional for me to end our podcast this time of year by asking you how many games is Scotland going to win in the Six Nations that's coming up? I'm afraid to say the track record is a bit of serial disappointment.
Yes, the words serial and disappointment apply to Scottish rugby fans, the Scottish rugby team, and all of that. And sadly, our captain, who is a very good player, is out for the Six Nations. Sione Tuipulotu, that well-known Scotsman, whose grandmother comes from Greenock, should I say. But he's a heck of a good player. Sadly, he's out. So I was quite fancying them to do well. They start off against Italy at home, and if they were to win that, they then play Ireland at home. They haven't beaten Ireland for a decade, and I would hesitate to go against opinion, so they might struggle there. Then they're at Twickenham. They've got that hoodoo off their back. I think England possibly are on a recovery tack, although I know they've lost a lot of games, but narrowly, and that'd be an interesting one. It's genuinely 50-50. I have to say, I think the best team this year might well be not located in the British Isles. but somewhere south of there. They seem to be doing quite well. And sadly, Scotland's final game is in Paris. But we shall see, Jonathan. We shall see. You never know.
Hope springs eternal. Hope springs eternal indeed. Very good. So, Peter, thank you very much. That was Peter Hewitt, the manager of the CT Global Managed Portfolio Trust, which has a couple of share classes, growth and income, which we've talked about. So look forward to our next conversation. Always do, Peter, and we'll look forward to speaking to you again soon.
Thank you, Jonathan.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.